Well, joining me right now at Post 9, CNBC contributor Courtney Garcia of Payne Capital Management. Welcome back. It's nice to see you.
Thanks for having me.
The minute the professor said that, I remember, you know what? I read Courtney's notes, and she likes international over the U.S. too. Is that right?
That's correct.
Why?
Yes. You know, what's really happened here, especially over the last years, international has just been so downcast and the valuations become so much more attractive, right? I mean, take the NASDAQ that trades about 20 times earnings, whereas your emerging markets trade about 11 times earnings, your European companies trade about 12 times earnings. And you're already seeing how much they've bounced back since middle of October. But especially with China reopening, we went from all of a sudden Europe was definitely going into recession to now we're saying, okay, well, maybe they can avoid a recession. China's coming back online. The picture has completely changed. I think that story is going to continue this year.
You can do it through developed markets, ETFs, and emerging market ETFs, like
Correct.
both?
Both, correct.
Okay. Let's turn it back to how we were going to begin before the professor surprised me, frankly, in what he said. This idea of what's hanging on next week. I hope you heard him suggest that we should fade the rally in tech. Do you agree with that?
Yeah, I'm really almost everything he said. I was listening to the whole thing, and yeah, we were around that.
Because I said NASDAQ's up like 11% to start the year.
It's doing fantastic, but I don't think really what's changed is a lot of these companies are still at really high valuations, and even, you know, regardless of what the Fed does, right? So even if they raise 25 basis points, and even if they pause after that, we're still likely going to be in this higher rate environment, this higher for longer environment, and those higher valuation companies are going to be under pressure. And I don't see this as that different than what happened in the early 2000s. You had a lot of these false starts with your tech companies where it seemed like the rally was, you know, the dip was over. You could go back in. But it wasn't, right? Because you had several of those, but ultimately the valuations came back down. And again, you know what happened over that same time period? International outperformed. I don't think this is that different an environment than we were back then.
Are you separating the ones we're looking at on the screen right now, the Apples and the Metas and the Microsoft, Amazon's, Alphabets, from some of the ones that I mentioned to the professor, like the most shorted names, some unprofitable tech, or is it just fade tech altogether? It's going to be a value over growth kind of year.
We're definitely doing value over growth. That being said, we still own growth, right? I'm just not actively adding to that currently. But yes, your higher risk assets. So think of like your Bitcoin's doing really well, your meme stock's doing really well. You have this big risk on assets. I would put your non-profitable companies in a different category as like your Apples, your Googles, and Microsofts. I'm not touching either of those, but it's those non-profitable companies, those specifically are the ones I'm definitely not touching right now.
What you just mentioned, like, you know, Bitcoin rallying a lot, Tesla, et cetera, does that make you less of a believer in the overall rally in the market itself?
It doesn't. I think this rally can continue. I just think where you
think it's real.
I do. But the tech rally is different than the overall market, right? And I think this is where things get confused because tech has been such a large concentration of the S&P 500. So when you think of the markets, you're thinking of tech. So it has been that if tech does well, the markets do well and vice versa. But I think there's a lot of sectors of the market that can continue to do well, even if tech doesn't necessarily continue its course here.
So let me ask you this then. Why do you think we're rallying? What's this about?
I think the economy is on a lot better footing than I think people are giving it credit for, right? I mean, we're about 6 months of inflation coming down, which is really good news. That's really the biggest reason that the markets have been doing poorly the last year. China's reopening, which I think is going to be a bigger story, not just for China, but for the global economy as a whole. And I think one of the big things is the labor force. I mean, even with a lot of layoffs that are happening in tech, there's still a huge labor shortage. If people are still having higher wages, they're still spending, they're still putting money into the economy, that's still going to drive things moving forward here.
You heard the professor, though, who suggests that really the only way that you can get even close to 15%, or that he has a lofty target, obviously, for the S&P, is for the Fed to cut rates. This year, he thinks the Fed's going to cut rates in the second half of the year. Is that false hope, as we suggested, or do you believe in that scenario, too? And if not, can stocks still do well if the Fed is still doing their thing?
I mean, I think eventually they need the Fed to stop raising rates at a certain point, which hopefully happens in the springtime. Bond markets really are pricing that there is going to be a cut later in the year. Whether or not that happens, I don't know. I'm not going to go as far as say I think there's going to be cuts later this year. But I am hopeful that they will level off at some point. But seeing cuts, I think would be good for certain parts of the economy. But I don't think I'm going to go that far to say that I see that happening this year.